Hey there, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, May 14th, and this is on trend. So we've got a triple 90% down volume day, and we're going to look at that in detail. I'm going to update the breadth table, put this percent pullback into perspective, show you an oversold indicator, and look at tariffs. All right, I want to show you first what a 90% down volume day looks like. And I'm going to work my way through the New York Stock Exchange volume indicators. And then I'm going to get to the S&P 500 and the S&P Mid-Cap 400 and the S&P Small Cap 600. And the only reason I'm using the NYSE is just to show you how it's calculated and how it works. As you know, I think if you just use NYSE breadth indicators, you're not playing with a full deck, because we know that the S&P 500, around 1/3 of the stocks come from the NASDAQ. So if you're leaving out the NASDAQ in your calculations, you're not looking at the market as a whole. You're missing at least 1/3 of the market, and you're certainly missing some of the key players like Apple and Amazon and Alphabet. So if we look at this NYSE volume chart here, at the top window we've got the New York Composite Index, and then we've got New York Stock Exchange up volume, New York Stock Exchange down volume, and New York Stock Exchange unchanged volume. So we got up volume at 85, down volume at 840, clearly a big down volume day. And you add all three of these together and you get total NYSE volume at 931. And you can also see these numbers over there on the right scale. So now I'm going to flip over to the next chart here. And what we've got is we've got the NYSE up volume still, NYSE down volume. And now in the next window, I'm dividing up volume by total volume. And you can see it's 0.09. So that's basically 9% of all volume was up volume, and you can see that over on the right as well. And then we have down volume, and you can see that down volume was 90%, 0.90 of total volume yesterday, and there you can see that big spike there and that big move. So a lot of down volume. In fact, the biggest percentage of down volume you can see since December. And you can see the decline in December started with that big spike in down volume. Now, the way I created this chart is if you go down to this indicator window, what I'm using is a colon to divide up volume by total volume and down volume by total volume. So I entered price as the indicator, and then in the indicator box, I've got NY up volume colon NYTV, which is total volume. And then I did it for down volume as well. So that's the way I create that ratio of the two. And then I just colored up volume green and down volume red. So now if we look at this next chart, we can see how we get up volume, down volume percent, which is the basis for the S&P indicator that I'm going to show you here. So there we have up volume and down volume. And here we have up volume minus down volume. Well, actually, this is up volume minus down volume divided by total volume. You can see the calculation there in the little window. So we have up volume of 85, down volume of 841. We subtract up volume from down volume, so we get a negative number divided by total volume. So that is up volume, down volume percent, minus 81%. And we can see that when you get a minus 81%, when you have net advancing volume divided by total volume, that's the equivalent of a 90% day in declining volume. So there you can see declining volume was 90%. So now let's move to the S&P 500 indicators. All right, so now I've got S&P 500 up, down, volume percent, S&P Mid-Cap 400 up, down, volume percent in the middle window, and S&P Small Cap 600 up, down, volume percent. And you can see all three readings are below minus 80%. And so when you get a reading below minus 80%, that tells you that down volume was 90% or more of total volume. And so if we look at this indicator, you can see we've gotten the triple 80% down volume day basically here yesterday on Monday. So that's a lot of selling pressure. And you can see the last time we got such readings was in December, and that December decline kicked off a decline throughout the month. But when we got the bottom, notice that we had two 80% up volume days in all three indexes, S&P 500, 400, 600. So we got one in late December and one in early January, and that kicked off this big rally. So you say, well, is this a bearish indicator? Well, it's happening at a different spot than it did in December. So you can see in December when we got this triple 80% down day, it came off of a peak. All right, we had been advancing for 6 days, and that signaled a reversal, and we continued lower. This time, we've been declining for 8-9 days. So it's coming after a 5% decline roughly from the high. So it's coming when you're already short-term oversold. So as with lots of aspects of technical analysis, it has a different meaning depending on where it happened. And the fact that it happened when we're oversold means that this could be some sort of a selling climax and lead to an oversold bounce. Now, we also had another triple 80% down day in AD%. And AD% is just advances minus declines divided by total issues. So when you get that minus 80% reading, that means that 90% of stocks in that index were down on the day. And so you can see we've got it for the S&P 500, S&P Mid Cap 400, and S&P Small Cap 600. And this is the second reading in as many weeks. So we've had a lot of selling pressure over the past 5 days. And if you look at previous readings, we had one in October, and we had another one in December. And then you can see there in late December, early January, we had the double plus 80% readings when all three moved above plus 80%. That was a bullish breadth thrust. And we're getting the opposite here. We're getting a bearish breadth thrust. And you say, well, that should turn you totally bearish on the stock market. Well, I'm still in the pullback camp, and I'll tell you why, because I have some medium-term indicators, and they are still on bullish signals. So let's look at those next. So I've got a breadth table that I keep track of on a regular basis, and it's usually posted in the weekly market review and outlook on Fridays. But since we had that big down day on Monday, I decided to update the breadth indicators and the table, and there is no change. So in the previous chart, I showed you we had daily readings for AD%. But as far as the medium or longer term signals are concerned, I take a 10-day EMA of that indicator to look for a bullish or bearish breadth thrust. And this is kind of similar to the logic behind the Zweig breadth thrust. Marty Zweig also used a 10-day moving average for his indicators. And so I kind of cribbed off of Marty Zweig's work. And so I've got a 10-day EMA of 80% for these three indexes. And you can see we got bearish signals in early February and in late March when all three triggered in early February. 2 of the 3 triggered in March. And so this indicator turns net bearish when at least 2 of the 3 trigger. And it did not trigger bullish again until January 10th. And that's when we had enough breadth to push all 3 above plus 30%. So, in between we had some odd readings above plus 30%, small caps down there in May, and the S&P 500 in November, but we never got 2 of the 3 on bullish signals until January 10th. And so this indicator remains net bullish until we see 2 of the 3 move below minus 30%. And right now, they're all in that minus 16 to minus 19.5% range. So it would take a couple more days of selling pressure to push this indicator bearish. Now, I'm not going to predict a signal. I'm just going to take it when it comes and react accordingly. So the next indicator in my trio of breadth indicators, I have a trio of indexes, the S&P 500, S&P Mid-Cap 400, S&P Small Cap 600, and together they cover large caps, small caps, and mid caps. 1/3 of the stocks come from the NASDAQ, 2/3 come from the NYSE, so it's a very broad representation of the market. It's not like just the NYSE breadth indicators or just the NASDAQ breadth indicators. So I've got these 3 indexes, and then I've got 3 indicators, so that's 9 total indicators. So you're always going to have a majority. Either 5 of 9 will be bullish or 5 of 9 will be bearish, or more or less. But you're never going to have a tie. All right, you can't have 4.5 and 4.5. It's always going to be 5 at least. So if we look at this indicator, the high-low percent indicators have been dragging their feet for small caps and mid caps. So we had a bullish signal back here in March 2016, and that did not turn bearish until October 2018, when all 3 moved below minus 10%. And when you get that kind of a move, it shows you that there's a lot of stocks leading or making strong or in strong downtrends, because if you're hitting a 52-week low, you're in a strong downtrend. And so when high-low percent goes below minus 10%, it's a lot of stocks in strong downtrends. And we had that again in December when all 3 moved below minus 10% again. Now, going into February, only one of them triggered, and that's part of the reason the breadth table turned net bullish, because the S&P 500 high-low percent got above plus 10%. It didn't get very far above plus 10%, but it did. Mid caps did not, and small caps were even weaker. So we're not getting that broad participation where we're seeing mid caps and small caps, a lot of new highs in those 2 indexes. So this indicator is dragging its feet. Now the third indicator is the percentage of stocks above the 200-day EMA. And basically, when you get above 60%, that shows enough critical mass, enough stocks in uptrends, well above 50%, to support a bull market. And when you get below 40%, that shows enough stocks in downtrends to support a bear market environment. So you can see this indicator also turned net bullish in March 2016, and then it turned net bearish on October 11th. 2018, when all 3 moved below 40%. But since then, all 3 have moved back above plus 60%. First, it was the S&P 500 leading, and then the S&P Mid-Cap 400 and small caps. But small caps weakened quickly, and you can see they got below 40% in March. And so that's why the indicator table only shows 5 of 9 indicators currently bullish. Or excuse me, 6 of 9, as you'll see here in a minute when I show that table. If you look at the indicators where they stand now, 57% of S&P 500 stocks are above their 200-day EMA, 46% of mid caps, and 41% of small caps. So small caps are still dragging their feet. So here's the table that I update, and this kind of helps me keep on the right side of the market. And sure, ideally, like in 2017, all 9 of these indicators would be bullish. But we don't have an ideal market right now, because you can see that 6 of 9 are bullish. So the green show the bullish signals and when they occurred, and the red shows the bearish signals. And those bearish signals from October are still in play for high-low percent in mid caps and small caps. And then we got a bearish signal and a percent above the 200-day EMA in small caps in March. So this tells me that, okay, roughly 2/3 of the market is doing okay, 1/3 is not doing okay. And that's a pretty big chunk, but still I take a weight of the evidence approach, and I still think the market is net bullish. But the fact that you have 1/3 of these indicators bearish tells me that it's a stock pickers market or an ETF pickers market. You need to be in the right group or in the right stock, because if you're not, you can you can have trouble. As you've seen from earnings season, a lot of the stocks that I picked before earnings season were clobbered. It was not a good season for me for earnings. I had a great February and a good March, but April and May have not been good months. So what about the S&P 500? Well, let's try and take a step back and look at what's happening here. All right, I do agree that the market is a bit out of control, and I'll show a weekly chart here in a minute to illustrate that. But, if we look at the bulk of the evidence, we can see that price is still above the 200-day moving average, which is right there around 2776. We can see that the 20-day moving average is well above the 200-day moving average. So those two things point to an uptrend. We can see we had a 52-week high a couple weeks ago, not very long ago. We had a 26% advance from late December to late April. So you're entitled to a pullback. I mean, seriously, should anybody be surprised that we got a pullback? Sure, it was sharper than anyone expected. And sure, there's a lot of noise regarding this tariff stuff, but it's a 5% pullback. It's about 1/4 of this advance. So what I did was I put on the Fibonacci retracements tool, and I'll show you how I did that. I'm going to go to the annotate button down there at the bottom, and I'm going to select the Fibonacci retracements. And so when I draw Fibonacci retracements, say I'm just going to do them over here so you can see how it works. So what I'm going to do is I'm going to hold that click, and then drag again. You can see I get the other numbers. I get 23.6%, and I get down here 161%. And so if I click and then drag that again, they will disappear. So that's the way I got that extra number of the 23.6 to appear. So basically, we've retraced around 1/4. So that's like 4 steps up and 1 step back. And so I cannot turn bearish on the stock market when the Brett table is still 6 of 9 indicators bullish. Also, when we're just having a pullback, a 25% retracement of a massive advance after a 52-week high. So I just don't see enough evidence to turn long-term bearish. Now in the indicator window, I've got RSI, and I was noting this bull range and this bear range. So we're in the bear range from October to mid-January, and we've been in the bull range. Now we did move out of that bull range, but we are above 30 still. So we have not become oversold. And if we go below 30, like we did here in October, I think that would be a negative. That would be another negative indicator to put and start putting into your weighing process. Because when you go below 30 with 14-day RSI, that signals strong downside momentum. The kind of strong downside momentum that can suggest that this decline has further to go. Sure, you're oversold when you're below 30, but with 14-day RSI, I think that signals a significant amount of selling pressure that the market may either go nowhere or may have further to decline in the coming weeks. So that's why I'm not too negative on this break below 40 yet, but if we go below 30, then that would be pretty negative, I think. So if I look at this chart, and I didn't know it was the S&P 500 and it was just a stock, I would pass. All right, when I'm looking at stock charts, I'm looking for nice, stable, strong uptrends. For instance, if you look at this period when we broke out here in July 2016, we had that little pullback, moved higher. This is a nice, steady uptrend that you want to look for in a stock. But if you look at the S&P 500, you had a 12% decline, you had a 16% advance, you had a 20% decline. And what's remarkable about this advance is we really didn't take the stairs up here. We took the elevator up because it's pretty much as sharp and as straight as that prior decline. I mean, they say that stocks take the stairs higher and they take the elevator lower. But man, this is clearly taking the elevator higher. So the swings are just getting bigger, and this is a bit disconcerting because it shows increasing volatility and, kind of euphoria on the upside, and then excessive despair on the downside. Because, you have this overshoot to the downside. Maybe this is an overshoot to the upside. So this is a concern, the fact that we have this kind of out of control market. We've gone nowhere. We've gone everywhere and nowhere for 67 weeks. And if you look back over here in 2015, we had this 90 weeks of nowhere, basically. We first moved above 2,000 there, and we were above and below 2,000 for quite some time. So we've been above and below whatever level you want to pick here, 2,700, for quite some time here and gone nowhere. So I've mentioned before that, support and resistance levels, it's an imprecise science. It's not really a science. I mean, we're basing it on theory, what we've learned in the books, looking for prior lows, looking at retracements, looking at moving averages. But, there are a zillion potential support and resistance levels. And overbought and oversold are a bit the same way. Overbought and oversold are imprecise. You can see here that in March, RSI moved below 30 and back above 30. So that was a really nice oversold reading. Short-term oversold, and then you got the little bounce and the breakout there, and that led to a nice move. We didn't become oversold in late March, but we got a little pennant thing and got a breakout. Now here we became oversold last week, but I think what made this a failure on this bounce was the fact that we had that 90% down day in the 80% indicator there. And so that was telling you that there would be more selling pressure before it was over. And we've gotten our second 90% down day, and we're at support here. Right? You can see these highs. We can even do the highs back here from October, November, December. Highs here, the low here. So 280 is support. And then if you look at that candlestick that formed yesterday, it's an indecisive candlestick. All right, you can see that the high and low are marked. I'll go ahead and move to a line to draw that candlestick. So the high and low are marked here with the line. And then you can see the body is pretty much in the middle of that high and low, and it is filled. So it's basically indecision because you're kind of in the middle of that range with your open and close. So we could get a reversal and bounce off support here and get that oversold bounce. Now the second indicator I've got here is the percentage of stocks above the 20-day EMA for the S&P 500. And it moved to its lowest level of the year. It finally moved below 30% to become officially oversold. And what's interesting about this indicator is you can see it can move below 30% and remain below 30% when the market trends lower, as it did there in October. And in December, it moved below 30%, but you wouldn't have gotten in until you got that move out of the 30% territory when stocks started turning up. So if this moves back above 30%, that would be the first signal that we're getting an oversold bounce. Now, this type of trading is called mean reversion trading, and it's based on a premise that you have an uptrend. So we're above the 200-day, we're clearly trending higher. You get a deep pullback, and the idea is you're going to revert back to the mean of that trend at some point. Now, with mean reversion trading systems, I've found that what you need to do is you need to have a pretty quick entry signal to trigger that you're turning up, and you also need to have a clear exit strategy. And that can be a profit target. I would think in the 290, 292 area might be a decent profit if we make it up there. And you also need to think about your position sizing because you don't want to bet the farm on an oversold bounce. And that goes with any trade. All right. You want your trade sizes to be small, and the smaller they are, the less emotional impact they're going to have on your decision making. But by far the most important thing is to plan your trade before you make it. And once that plan is made, trade that plan. Do not deviate from it. So I have got an unorthodox chart to show you, two as a matter of fact. And I went to Google Trends and I typed in the term tariff. And I wanted to learn what is the interest in this search term according to Google, which is of course the biggest search engine. And there's the interest over time. And this goes to May 2018. And you can see that the interest in the term tariffs really spiked over the last week or so. So I'm going to go ahead and back this out, and you can do a custom time range. And I'm going to go ahead and do that for 2017. We'll just go 2 years on this, and I'll get a refresh. And there you can see we got a spike at the beginning of 2018 in the first quarter. So what does this look like on a chart with the S&P 500? So what I did was I created a user-defined index. And if you want to know about a user-defined index, you can just go and search for that term at the top right-hand corner of any web page. And so I search user-defined index, and there's the first hit. There's a support article, and it shows you how to create a user-defined index. Now, I would point out that the user-defined index is specific to each user. In other words, it's in your account and it cannot be shared to other StockCharts users. I'm sorry about that. It is unavailable. So this user-defined index I've created is with the symbol at tariff, but it is only in my account. All right, so you won't be able to click on this chart and save it. So there's the Google Trends chart for the interest in tariffs. And I suspect when we're looking for the interest in this search term, it's mostly for negative reasons, because negative news is what generates all the interest. Come on, it's not positive news, it's negative news. And you can see here that we got this spike here in January of 2018. It kept spiking up for a few more months, and the market went into a volatile range. But this was after a huge advance. So it was normal to have a pullback or consolidation. And the market did that. And then we got a breakout from this triangle and a continuation higher. So then we had this decline. And now we've had to move to new highs. And we got a spike in the tariff interest. And we got a decline in the market. And you got to think, well, the worst 4-month period is coming up in June. So if this tariff thing continues to be of interest, we could see a choppy environment at best, or maybe even a deeper pullback at worst. But I'm still going to cue on the charts. I'm going to cue on the breadth indicators and take my signals from the charts. This is mostly for observational purposes. It's an interesting tidbit here, but I'm still going to take my cue from the actual charts and the breadth indicators. All right, so this next chart shows the interest in the search term Fed, as in the Federal Reserve. And what's interesting I noticed here is there you can see these spikes when the interest goes above 60. And it's happened a few times over the last couple of years. But I noticed that the market doesn't perform very well when this happens in the coming weeks afterwards. So this is kind of interesting here. There's the December debacle, and then we've rallied since, but the interest in the Fed is not really very high right now because there is so much interest, I guess, in tariffs. But it's something you might keep track of later on if interest in the Fed increases, which it probably will do at some point. That could be a negative in the market because usually it's negative interest. All right, so that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.